All right. Well, welcome everybody. Thank you very much for attending our session. Obviously, I'm not John Sanfilippo from Finitopolis. He actually got impacted by the CloudStrike debacle, so he wasn't able to make it. So I'm Brett Wooden. I'm filling in. I am an FI software strategist for Buildable. I've been in the credit union industry for about 25 years. I've done everything in a credit union except for accounting and finance. My friends in the industry say that I like to spend the money, not manage it. You know, I'm really excited today. We've got, three things that are kind of pressing our industry. The first one is we've got all this data, plethoras of data, and we're trying to figure out what we should do with it. We've got alternative data that we're trying to throw into the mix. Then we also have, our member experience, and from the session today, it's deepening our relationships. How can we solve friction, make it seamless, and make this amazing member experience? And then last, you throw in this whole AI thing, right? And I don't know if that opening session made me more excited or kind of made me a little nervous. But as credit unions, we're trying to keep up with this, figure out what's our AI strategy and that. And so really our focus today is we're going to focus and take these 3 points and look at how can we do loan decisioning and risk management, and with all this data at our grasps, and really compete against the bigger banks by making the most informed and accurate lending decisions possible. And so I'm really excited to be joined with Chris Hamilton from Golden One Credit Union in the States in California, and then also Tom Tobin, the founder and CEO of Modelshop. Thank you very much, gentlemen, for being here.
Great to be here.
Great to be here.
Great. So Chris, let's start with you. Just give us a little bit of your background and what do you want the audience to get from this today?
Perfect. And again, thank you for stepping in.
Oh, yeah.
Much appreciated. As he indicated, I'm the Chief Lending Officer for Golden One. We serve the entire state of California. From a career perspective, I've spent most of my career at big banks, think top 5 banks in product roles, analytic roles, risk, as well as operations. Most recently, I spent time in the fintech space, joined a couple of fintech organizations. I think what to take away from this is, I'd say the big takeaway is if you haven't started the journey, it's not a big bang. You can step into it and learn your way into it as long as you lay out the right roadmap and have the right engagement with your leadership team.
Great. And I'm Tom Tobin. I'm the CEO of Modelshop. So I'm through and through an AI geek. My undergrad degree was actually in machine vision, believe it or not, back in the 80s. I'm maybe dating myself. But spent my entire career focused on using data and analytics to make decisions. Joined a small company back in the mid-90s where we did 2 things that were very interesting. One was the first neural net-based fraud models. So the company is called HNC Software, and we sort of solved the fraud problem for a while in the credit card industry. Massive reductions in credit card online fraud. And then the other thing we did was we did some of the first instant online credit card issued decisions. So I know you could go in and get a Sears card in the store, but for the first time, you could, instantly get issued a card. And we worked with Citibank and Capital One and First Union, where Chris and I actually met many years ago and worked together to solve that problem. So became hooked in financial services. I wasn't really sure that's what I would work on when I started working on machine vision, but that's where I've been ever since, and it's been a great journey. So very briefly, Modelshop really is a company I started in the ripe old age of almost 50 to bring that experience together and make it more accessible to financial institutions, including credit unions.
Great. All right, now the fun part. Now buckle up. We're going to start asking the questions. So, I guess the Hollywood definition, right, is the Terminator. AI, the definition, right, for Hollywood is Terminator, Skynet. So we got to hear your guys' definition of what AI is to you. So Chris, let's start with you first. So how do you define AI?
So it's funny, we talk about AI, but when I think about it, it's been around for a while. And Tom will probably hit on this as well, but think of AI as nothing more than what a person would do, what your average person would do when faced with the same facts. How would they make a credit decision? How would they engage with the member to understand what their financial needs are and how I can best serve those needs? But if you take a step back, AI has been in financial services for years. Your FICO score is a I would say rudimentary AI tool. It's a logistic regression, which is a form of machine learning, which is a form of AI. So I think that we all have experience using it. It's just how do we continue to evolve what we're doing from an artificial intelligence perspective. And that really does include all the data that you can bring in, as well as the decisioning platform that you use to manage all the data aggregation and to manage your decision strategies most effectively.
Yeah, well, I don't know if I'd call the FICO score that rudimentary, but so actually that company I mentioned earlier was acquired by FICO, and I spent about 10 years running their scoring engines and tools. So that was, they do some really interesting things like liquid scorecards and interpolation. So they're doing some pretty interesting math that's much more than a scorecard. But my definition of AI, obligatory conversation topic here, but is pretty broad. I see a huge spectrum. All the way on one side, automatic doors. That's a form, honestly, of AI. Very simplistic, but it's emulating what a human can do. It's smart enough to open the door for you. All the way through to the Ray Kurzweil, singularity stuff when there's we're anticipating general intelligence. In the middle, where we really play today, we've evolved from expert systems, which I feel like are an early form of AI, machine learning, which we've been doing for decades. And what we're seeing now is the machine learning tools have gotten so much easier, and there's some great companies that can help you build customized models. And that allows you to tailor your analytic decisions for your member base, for the communities you're trying to serve. And that's a huge leap, I believe. Going forward, large language models, generative AI, that puts a human touch. It's exciting for everyone because it feels more human. You can interact, you can see, you can listen to, you can talk to these systems. And that's really where we're going pretty rapidly. I think these are all going to blend together under the umbrella of AI. Now, last thing is my passion is around automation. I think the math and the analytics to segment, classify, that's great, but bringing all the data together at the right time to serve your member and provide a frictionless experience guided by that intelligence, that's the hard part. And I think that's what a lot of organizations have really struggled with, and I think we're making great strides to solve that.
Just to add one thing onto that, because I think it's really important. At the end of the day, credit unions are about members. I view AI as an enabler to actually deliver a better experience, a superior experience to that member. It's not about a risk, just the risk of the person. It's about how you enable the right conversation with that member and find a way to get the right product to that member. So I view it as a big enabler, not just a platform or a process that we can execute.
Yeah, and that's what differentiates us, right? Well, so let's move on to alternative data. So how do you define it, and why is it important?
So I'll start here. I'll let Tom add his 2 cents. My sense is he'll have a similar thought to me. Number one, I really don't think there is alternative data. If you think about the decision making, you want as much data as possible to make an informed decision. So it's not alternative data, it's additional information that enables you to make a more informed decision. If you think about credit unions in particular, we have tons of information on the consumer. Think about the checking account that most of us have, the savings account that most of us have access to the data that's in there. That data is incredibly rich, both from an aggregate perspective, how much do you have in savings, how much in aggregate deposits do you have every month, as well as the individual transactions themselves. How are you using payment vehicles to facilitate and manage your life and your obligations? That data is incredibly powerful, but not just from a risk perspective, but from a product. How do I identify products that you can use from potential attrition risk? So I think it's not just, I don't think of it as alternative data. I think it is incremental data that I can use to make an informed decision, understand, and I'll use it for credit purposes here, understand what someone's credit profile looks like. How do I understand that it's the right product, I'm going to price it the right way, and I'm going to give them a loan or a line amount that actually meets their needs. That's what's really powerful from a data perspective.
And you've been working with it for some time now. So.
Yeah, I agree. I don't call it alternative data. I call it not credit data. So, expanding beyond the traditional, the traditional credit score and credit details to look at the full financial picture. The other term I don't love, even though it's on our booth, is cash flow underwriting. So it's not just about cash flows, and that's the next obvious topic after you start looking at open banking data. How do we use it to understand the financial risk that a particular member might be experiencing or an applicant? And I don't think about it as just cash flows. I think of it as financially modeling your members' experience, the way they work with finance, the way they work with their credit, with their existing products, their deposit accounts. And with that detail, being able to make smarter decisions to help guide them through their financial career, especially if you're starting early on. I mean, an example of a new grad that maybe didn't have a lot of help getting through college, they graduate with a lot of student debt. I mean, a score and buckets, which is how most of the credit decisioning is still done today, can't capture that nuance. With the detailed banking data, you can go in and you can see who they're paying out to, what deposits they're getting. You can go into the credit detail and see, you can back into the structure of the student loans that they have. And from that, you can also look at what degree they're graduating with and get a feel for their future earning potentials. And you can create this conversation that puts them on the right path to be a loyal, contributing part of your community for years to come.
Great. Well, so, with credit unions, there's a lot of new technology coming out. It kind of seems like, yesterday's fast is today's slow when it comes to, new technology and data and AI. What are some of the shortcomings of legacy technology being used by credit unions today?
Yeah, I think and having been part of building some of that technology in the past, I have to...
It was cutting edge at the time.
Yes.
Cutting edge at the time. But, a lot of the systems that we're using for decisioning are way too rigid. They make assumptions about how you structure if we're talking about credit decisioning, how you structure your pricing, for example. We've worked with many clients that we've struggled with the pricing structures that the tools limit you to. Everybody, again, assumes scores and buckets, right? You get a propensity for repayment score, and you look at a few ratios, DTI, term, a couple other things, and you put people in buckets, which is, it's kind of a pretty blunt instrument. And then as we're working with credit and risk teams that want to be more innovative, they want to do trial pricing, they want to do tests, they want to potentially do pricing elasticity analysis. If it takes 2 months to roll out a new pricing structure because it has to touch 5 different systems, and for some reason every system wants to know what bucket you're going to put somebody in, it kills agility. And I think it's time for those systems to become modernized.
Yeah. So how about you? I'm sure your inbox is full of new technology. So, what are your thoughts on this?
So similar to Tom, when I think about what we're trying to accomplish through some of the transformation that we're doing, I would say it's really a couple of things. One is, and I talked about a little bit earlier, that personalization. That really understanding who the member is, and then how I evaluate that risk, evaluate the product fit, and how do I evaluate the terms of the loan that the member is looking to acquire. And then how do I interact with that member the right way? Tom used an example of a recent college grad. Another example could be someone applying for a credit card. I see that they have personal loans out there. I can actually give them the credit card, and I can save them money by giving them a personal loan offer, refinancing that personal Having that dynamic platform that can enable that insight and that personalization of that offer to the member is a winner. That does engender loyalty for that member. The other piece I think is important, Tom hit on this as well, is you have to have the ability to test. You might have a hypothesis around how a certain segment of consumers or members are going to behave. How do you evaluate that hypothesis on a go-forward basis? And that's actually really, really critical. You put a product out there, put pricing out there, put loan amounts out there, and evaluate the efficacy of those strategies over time. And it's not just the origination strategy, it's the ongoing strategy. So being able to enable that personalization and have the ability to quickly adapt to what's going on in the marketplace, implement new strategies, that configuration and the testing, those are the three pillars that we're looking to leverage as we go down this path.
Well, and how do you see the challenge, or if you put all this in place, achieving your goals? Like, what do you see in the future if you utilize all this?
I would say a couple things. So when we think about, and we're right now we're focused on the digital front door, the digitalization process, and I would say that if you do this the right way, you do a couple of things. One is you engender loyalty on the part of the member. Quick decision. When I get the feedback, it looks like it's an equitable decision. I'm able to present offers that add value to the membership in a very dynamic, real-time type iteration with the interaction with the member, and that ultimately enables growth. So if I think about what we're trying to accomplish, it is really to meet the member where they are, deliver the product that they need, and through that engender loyalty and growth for the credit union as a whole.
And Tom, you wanted to make a point?
Can I go back to the tools thing?
Yeah.
Because you said something that sort of triggered some thoughts. But one of the biggest problems with the tools today that I see is the impedance between what the risk and the credit teams, so your teams effectively, that they work with to do this analysis, to understand the impact of their portfolio, doing projections, and the tools that the IT team uses, whether that's vendor provided or home built, to automate all that. And they're typically completely different systems and technologies. There's a reason for that. The risk team needs a high degree of agility, right? They work with spreadsheets, or more advanced teams are doing a lot of things in Python. And then your IT teams are structured, SQL coding, and there's a big gap between those two. And it turns into months and months to get any new data integrated to the production system. So the risk and credit team wants to innovate, and they're like, well, if we could pull this information in, it'd be great. All right, we could do that first quarter of next year. Like, how do you innovate? So I see these tools coming together, and there's a couple of things that are driving that. One is the tools are just getting better, right? It's easier. These no-code environments make it easier for non-coders to work with more advanced tools. And the other thing that's happening is the data is getting more complex. So it's starting to outstrip the risk and credit team's spreadsheets. They need help. They need somebody to pull features out of that data in a way that they can use it in their analysis. And while you're doing it, let's do it the same way in production, so you have consistency. So that's a trend that I'm seeing in the tools.
Oh, great. Well, yeah, so let's stick with you. And I hear a lot of AI underwriting. I generally think of a score that drives that credit decision. So tell me the difference, because I think a lot of us don't know. What's the difference between a score and AI decisioning?
Yeah, it's really at the core of where I see these AI decision platforms going. A score is a classification model, basically. You're putting people into tiers, buckets. And interactive decision engines now have the ability to respond to new stimulus, new events, learning new information, whether that's an applicant putting something online or some data that you pull. And then they can drill into the detailed data and extract features on demand, such as, here's what this applicant's student loans look like, right? And by the way, this is how long they've had them. We can estimate what the interest rate is, and now, you can put together a strategy for how you can produce the best solution for your member. which is very different than a score. Like, you cannot pull all that out of a score. A score is a propensity score for, likely repayment. They're getting more interesting and starting to bring in the structure of the loan instrument, for example, which for a long time that was, 2010, on the tail end of the mortgage crisis, I did some work analyzing secondary market portfolios in this space and understanding, like, how did we get into this mess? And it's just amazing how, people are like, oh, you have a good credit score, you must have a good a reputable person, great, let's give you a mortgage that no way you can afford unless housing prices continue to go up, unreasonably. We've gotten a lot better about that. And now again, it's these ratios that at least put some guidelines or guardrails on the risk that you're exposing yourself to, but it hasn't really changed that much in a couple of decades, and I think it's about to.
Yeah, that's how I got my house, by the way.
A liar loan?
Yeah, there you go. That's well, any thoughts? Do you have any thoughts?
Yeah, and it's similar to Tom. We actually think of our overall credit strategy as kind of a decisioning framework, if you will. It is not a one-size-fits-all to score. It's no different than the five C's of credit. If you think about auto lending as an example, you're at least looking at 3 of the C's, if not 4. You're looking at LTV, you're looking at a DTI or a PTI metric, you're looking at a term structure, and then you're looking at score. So there's as a credit union industry, a financial services industry, everyone kind of uses the decisioning framework. What I think the technology enables you to do, and it wasn't even possible 15 years ago, is to aggregate vast amounts of data and manage it in real time and deliver solutions for members in real time. If you restructure, like, perfect example, a deal comes in an indirect channel. It might not come in to fit your box, but you can easily have your decision engine go back and say, okay, if you structure term this way, LTV advances drop down to 110%, term go to 66 months instead of 60 months. That makes it more manageable for the consumer to manage. You can look at their bureau and say, hey, they're managing debt this way today. You look at their deposit data, they have income to support it and service the debt. Being able to do all of that real time and not just make a decision on you're in or outside of the box, but being able to structure a deal real time and go back to the member, go back to the dealer and say, hey, we can't do this, but we can do this. That's valuable from a member perspective, and it's really valuable from a dealer perspective.
Yeah, and that's a beautiful expected member benefit, right? So, well, and so Tom, you work with others outside of the credit union industry, lenders outside. Tell us kind of what you've seen there.
Yes, well, so our first customer almost 10 years ago now was a very innovative subprime auto lender. And they were doing every deal on a spreadsheet. So they were really finding separation between the good credit risks and the bad credit risks amongst the subprime population. Which when I started working with them, I was like, I don't know what everyone feels about subprime, but initially I kind of went in thinking subprime. But I was actually amazed. They were very good at finding good credit risks that maybe had a bad streak of luck. And that was all done with basically cash flow modeling. And they were, that was 10 years ago. Now, back then you had to upload your bank statements, they scanned them, but we were able to help them turn these spreadsheets into real-time cash flow projection models. So they're risk weighted on a number of characteristics. And the lender did incredibly well in terms of slicing out their portion of the market. So good returns on what they did there. More recently, we've been working with open banking data. So we've been pulling Plaid for about 4 years with some regional lenders, and now they're seeing some really interesting lift in that data. When we first started modeling on some of the features coming out of the cash flow data, we expected discretionary spend ratios and things like that, the cash flow type things, to be the most predictive, potentially insufficient fund transactions. But what we found that was really interesting is finding off-bureau credit relationships was one of the first indicators of a distressed financial situation. So buy now, pay later, payday loans, and we can extract that out of the banking data. We can see where the deposits are coming from. We can see where they're paying, and that, with one in particular lender that we worked with, had a huge impact in what they projected their first payment defaults to be. So they could detect that distressed, information, that stress scenario, and with credit unions, what I love about credit unions is if you are able to detect some of that, you can work with your members and help cure it before it becomes a problem with the right product mix. I think that's the opportunity.
Nice. Any additional thoughts?
Yeah, I would just echo what Tom said. I've been using relationship data one form or another. It's become more sophisticated as the tools have improved, but for 30 years. 30 years ago, it was massive lift. If you think about the impact on your ability to assess risk, it dramatically improves it, number one. Number two, a consumer that, to Tom's point, that looks high risk, in reality might not be high risk. The Bureau is not the perfect reflection of how they manage their financial lives. And it creates opportunities for credit unions, I would say in particular, to really personalize the risk approach, the product approach, and the pricing approach to better meet those member needs, drive loyalty, and engender growth. When I think about how we should measure our success, I think about it in terms of when I want to be my member's primary financial institution, and through that, I want to be able to have a suite of products with that member, and I want to have increased wallet share with that member. And the data is really critical to achieving those two objectives.
Yeah.
Yeah, and I think just adding to that, there's obviously a lot of focus on equity, and there's been some situations where older models that really are based on modeling the people we know, right? Perhaps we've had experienced patterns. The average age of credit union members in the U.S. at least is running like 47 or something like that, right? So if you expect every new applicant, whether they're new to credit or immigrants, or you're looking in low income communities, to look like your existing member base, it's hard, right? It's not, their financials are just different, not necessarily worse, just different. So these newer models can do a much better job of being more equitable, right? You're looking at real features of how members are responsible with how they do their finances, as opposed to ratios that do rough classification and put them in like buckets. I use that term buckets a lot, I know,
yeah.
but it's just, it's, and by the way, these buckets are very hard to defend from a regulatory compliance perspective. Like, how do you decide what mix went into placing this applicant here? And the statistical tools and I know a lot of the AI vendors do a great job of being able to explain that and pull out reports and say, I can see where we're not showing unintentional bias.
Yeah.
But it's so much easier when you say, well, they spend more than they make, right, on a regular basis, and they're actually spending things on, potentially, questionable things, and they've missed these payments. That's very defensible from a compliance perspective.
Yeah, great point. And so let's move on. So why is auto decisioning so important? So let's just say I'm a credit union with maybe 20 to 30 auto decision rates, and I jump up to, let's just say, 90% auto decision rate. What's the impact on the credit union that would have?
Yeah, I'll take that first and then let you add your 2 cents, Tom. So first off, I think it's incredibly positive. It's a better member experience to have a decision now versus 2 days from now, 3 days from now, even a day later, versus an instant decision is incredibly powerful, and that does create a halo effect for the brand, for the credit union itself. Second thing is, from a member perspective, I think you're seen as being very responsive to the member needs. I'm applying for a credit card, especially if you can instant issue it, that would be even better. They could actually use it same day. I understand your needs. I approve your loan, give you your credit card, boom, you're done. So I think it is a different approach than, and that change is going to be difficult for the organization as a whole. Or maybe not difficult, but it is going to create some challenges. But I think consumers are going to demand it, especially the younger generation. They are not. It's an experience economy. If I don't have the right experience, and auto decisioning is a huge part of that decision. I've got to have the platforms, the intelligence, the strategies, the framework that can deliver that expected experience, real time or near real time, to engender the member loyalty and engender growth for the credit union.
Yeah, no, I agree. So I have two sons, a millennial and a Gen Z, and my oldest, millennial son is going through. He's going to grad school, and he's been applying for a couple of loans to help out. And I've watched him go through that process. He has zero patience, and he got 5 priced options in an hour and a half. And a lot of this is with fintechs. And then he actually went to our traditional banking experience and didn't get an answer. And was like, okay, well, there's so much for that. And just moved on. And that's my millennial son. My Gen Z son is even way further over the top. Like he has no patience for waiting for anything. He pays everything he does with a click on the phone. And they were digital first generations. That's how they learned. And I think it's an imperative for credit unions. I think if you want to attract younger generations, it's not going to be optional to get to a really high degree of automated decisioning.
Yeah, I had to leave my cell phone backstage. Our 18-year-old daughter, we got her a credit union credit card, and we hooked it to the Apple Wallet, and she's literally using it as we speak constantly, and I'm, that instantaneous stuff. Scary,
Good feedback, right?
Yeah, it's giving me feedback. Well, so, outside, how is this being used, the technology being used outside of origination?
I can start there. So obviously, we're trying to change the digital experience at the front end. That's a critical part of what we're trying to do as a credit union. But I would say when I think about the decisioning technologies, I think of it as an enterprise tool that I can use, number one, across the entire credit life cycle, across every credit product. Whether I'm doing risk mitigation on the back end from a collections perspective, whether I'm doing line increase programs for a credit card, whether I'm doing refinance for an auto or a mortgage loan, the technology enables appropriate management across the life cycle. When we think about the platform, we think of it as an enterprise decision engine. Anytime we're driving empirically based strategies, aggregating massive amounts of data to drive the right outcomes across credit, fraud. I would say think about money movement, how you establish your money movement limits, what you want to enable someone to do from ACH versus wire versus Zelle versus member-to-member transfers. The platform enables you to evaluate those members and develop appropriate strategies that do engender loyalty. It is personal to that person. And I think that's the key when I think about this technology. It's Tom talked about it. It's not about buckets and segments. It is about the person and how their behavior and how their management of their financial lives informs the credit union, how we can develop the right products, develop the right solutions for those members, and deliver the right outcomes.
Yeah.
I was going to just really quick, you had mentioned earlier about the secured card. Did you want to?
Oh, yeah, I can use that that's a perfect example.
Yeah.
So think about someone coming in. Perfect example is a kid graduated from high school, going into college. He wants to do it on his own, doesn't want to have his parents sign for him. He starts with a secured card, puts $500 down. From a overall credit life cycle management perspective, I can look at that behavior, understand how that individual, how that member is using their credit card, is using their checking account, see that they're managing it responsibly. 6 months later, I give them a line increase. And I'm not talking about $5,000 line increase. I'm talking about $500, $700. They've earned it. Give them, see how they manage it. And continue to do that until you get to the point where, say 2 years, 3 years from now, hey, here's your $500 back. I've got a better product I'm going to put you in because you've responsibly managed your financial obligations through the credit card, and I see how you're managing your overall financial life through your checking account. So having that interaction with the member and the ability to deliver a product improvement and then ultimately a new product for that member, I think is invaluable.
Yeah, that's awesome. And then Tom, what are you seeing with other clients you've got?
Well, this is why I love working with Chris's team. I mean, the vision comes from the executive team and Chris, and we love being able to respond to some of these ideas, requests, designs, strategies, and move very quickly and say, oh, you need that, you need this new data in, and be able to do it close to on the fly, like very, very quickly. And to me, it's a key decision you have to make. And there are obviously different credit unions at different size and different, technology teams and risk teams. But I kind of feel like some of these decisions can't be outsourced. There are certainly very important parts of it that can be very effectively outsourced with a company that builds scores for you or does some analysis, or certainly the identity vendors do a great job of pooling data and pulling that risk together. So it is a combination. It has to be, you don't want to reinvent the wheel, but that last mile of pulling it all together and making it yours, I think you have to own. And the great thing is the technology is getting to the point that you don't have to be an advanced data scientist or coder, or that you can actually assemble these solutions. And the agility to go and touch other parts of your member touch points is critical, so that you can stitch them all together. So we're seeing, our customers are doing quite a bit in servicing, mostly prepayment estimates or identifying at-risk members prior to where they can still help. Also doing some marketing, saying what's the best product that we can, how can we help serve the member better? Let's get that in front of them. So it doesn't have to be limited to just the credit decisions. One other thing is there's an adjacency around financial modeling. So the tools that we've created are inherently designed to look at back testing and aggregation of your portfolios from a risk perspective, because that's pretty much how you design your products. You need to be able to go back test, run simulations, say if we ease this up or we look at this additional feature, how will that improve our performance or allow us to serve more members without increasing risk? The natural adjacency to that is to do better analysis and performance simulations on your portfolio, and that gives you the latitude to potentially, for example, address lower income communities or expand your addressable member base, because you could run very, I don't know if I'll say accurate, you could very, very well thought, portfolio simulations to understand what, and run tests to understand what the impact might be.
I'll add one thing. When I think about the member, what's important to them, how you interact with them, I think there are two things that are really critical. One is obviously the member experience and how that experience gets delivered, either in person or digitally. And then I think about decisioning. And the decisioning really kind of captures the intelligence of the organization on how they want to engage with members relative to risk, relative to product, pricing, whatever limits you're going to put on the member. When I think about a decision engine, the decision engine is not just powering the digital, it should also power how I interact with my members as well. This is a little bit forward thinking, but that intelligence layer, which is what the decisioning engine encapsulates, is absolutely critical, in my opinion, to differentiating yourself strategically within the industry, within financial services industry, and I would say even within the credit union industry. I think it can be a great enabler to drive that loyalty and drive that engagement with your membership.
No, that's great. I think about something, Tom, you say a lot is orchestrating. We are orchestrators in what we do, and the credit unions are orchestrators on behalf of their members of gathering everything, and I think a lot of this touches on that. And well, we've talked a lot about the external members, so let's talk about some of the internal members, our employees. So how is this technology and it going to impact the employees?
I can start. Anytime there's change, anytime there's transformation, it's always a bit of a challenge in how you actually manage that change. But the one thing I would say is, and I don't think this is going to be any different. I think it is going to be challenging if you go from your example, 30% automation on your credit side to 90%. Your underwriting team, your processing team is going to feel some of that pain. That being said, I would say two things. One is, if you're delivering a better member experience and you're driving that loyalty for the member, you're going to enable growth for your organization. If you enable growth for your organization, you create career opportunities for your employees, for the employees of the credit union, and they see that, they feel it. They're consumers as well in the experience economy. They know what kind of experience they're delivering as a credit union. So I think that's it's entirely manageable, I would say, with the right leadership. The second piece is, in those situations where you do need to evaluate the risk more closely, you do need a person involved. That's where those underwriters come to play. They are going to have unique insight from years of experience. Tom hit on a little bit earlier, some of the subprime underwriters that he worked with, they were able to glean out something unique about the profile that they were looking at. That's what you want your underwriters to do. You want them to add value to the overall credit decision. And by driving automation, you're going to end up enabling those underwriters to evaluate the applications or the credit situations in general, whether it be portfolio management or on the front end on the origination side, where you need their additional insight and how that's going to add value to the overall decision-making and their engagement with the credit union.
Yeah, no, the only thing I'd add is there's a whole new generation coming out of school and excited about technology. Everybody learns technology regardless of what they're studying. If they're studying finance, they'll learn some level of technology. And I think to attract the best and the brightest into the future of your organization, you want to modernize, and that's what they're going to be. I think that's what your next generation of employees is going to want to work with, right?
Right, yeah.
So it's so currently you're learning the most you can from your experienced employees that have been doing this for years and capturing some of that in the tools that provide a more frictionless environment. And then going forward, you're going to attract a whole new set of smart folks to become part of your organization.
Yeah, that's great. Well, what about the member experience and member journey? How's this going to change, and hopefully for the better, right?
If done well,
yeah.
I do think it actually changes for the better. I think it is a better experience. If you have the right strategic approach and look at how you're approaching product, pricing, risk, attrition risk even, and develop products and services to meet the member needs, I think it is a positive outcome for the members as well as the credit union, as we've talked about. You can tell where my bias is. It's all around how do I personalize for the member to engender loyalty, meet their financial needs, and enable them to achieve their financial goals. Whether that's how I make a decision, how I offer products to them, how I price those products or services. It's a very holistic view that personalization is the kind of the foundational aspect of it. So it's not just a bucket. We treat everyone between scores of 640 and 680 this way. That's what we're trying to get away from and really make it personal to to the individual member, how do I craft a solution for you?
Yeah, and I think the net outcome is going to be, my credit union knows me, right? It feels familiar. And I go back to my sons. I can imagine them saying, "Wow, that was a great experience." I feel like I'm part of the community compared to maybe some of the fintechs that they can go and try to get the best offer. It's like they know me. They already had my information. They already know that you guys bank with us or whatever. And as a family unit, and that level of interaction can create a comfort level, a level of trust. And it's almost like we've come full circle from sitting down in a branch across the table from somebody and trying to reproduce that in a digital first environment, which our next generations are going to demand.
Yeah, and well, so if you look at a credit union, you've got AI, you've got alternative data, where do they start? We've covered a lot today, right? So where do they start?
Take that first step. The one piece of advice I would say is you don't have to do the big bang. You don't have to rip out your loan origination system. You don't have to update all of your risk strategies at the same time. I would say pick a product that you think this would be advantageous for. I think all products are, but pick one that for your organization and just start the process. The journey is as important as the destination. In fact, I would argue it's more important because you never actually arrive. It is a journey, and as long as you're disciplined around how you think about what you're trying to do for the member, how you drive the right outcomes for your member, just take those steps around the tools, the data, and you don't have to bring in 15 data sources, just bring in deposit data. Just start there, but take that first step and integrate that data into your decision making and how you evaluate the risk, the product, the pricing for a member.
Yeah, and don't get caught up in the hype cycle, right? We're going through a whole new hype cycle because of the generative, and large language modeling. So, and it's cool stuff. Like it makes it feel a lot more real and imminent, but it's still going through a hype cycle. I would avoid FOMO. Don't feel like, oh, everybody else seems to be doing AI. We got to do AI. You want to start with what you're trying to achieve, and then from there say, well, how can vendors or technology help us? Don't let I'm a vendor, but don't let the vendors push you into thinking that you should think about something a certain way. Start with what you're trying to achieve, and then go explore and say, how could you help me? And take some meetings, right? Maybe it's a little self-serving, but have the conversations. Let them show you their what technology is there, what's not, what's real, and start evolving.
Yeah, you kind of teed up that second question. So when I first talked to Tom, I had asked Tom. I said, there seems to be a lot of vendors in this space. Where does Modelshop fit in all this?
Yeah. So my biggest I don't know if I should say this, but one of my regrets is the name of the company. Everyone thinks that we build models, and we do. We have integrated machine learning, and you can do your own custom models. But there are great model vendors out there that have a ton of experience and lots of customers with and learnings from those customers. We focus more on what we call decision orchestration, and in the name Modelshop, think more like the shop, right? Photoshop doesn't take great photos, but it's about bringing it together and turning it into a solution, and we typically do the last mile. So most of our models, we have great plugins for external data sources and vendors and partners. We've integrated with Zest, for example, can pull those scores in, and attributes and insights, and then combine it with what you have locally, typically member data, credit data, whatever's happening with your online experience, and then personalize that to what you as a credit union are trying to achieve. So that's really where we fit. I think there's plenty of room for lots of great vendors in this space. We want to help orchestrate a lot of that.
Nice. Well, before we open it up for questions, I always like to. No panel would be a panel without asking this question of any final thoughts before we open it up for questions.
I'll let you start.
Yeah, I mean, look, I love working with the credit union community. I feel like in some other financial spaces, you get a lot of friction between organizations. Here, there's a natural, my experience is there's a natural tendency to want to work together to do the best thing for the member. You combine that with flexible technology, and I think it's a great winning combination. And I think that we're going to see a lot of great innovation coming out of this community.
Awesome.
I'd follow that. Like I said, start the process, start the journey around how you advance what you're doing from a broader decisioning perspective. The one thing, I'm relatively new to the credit union industry, been in the industry just over a year. And the one thing that I think is unique about the credit union industry is, like Tom said, you guys, we work together. We work together to solve problems, number one. Number two, I worked at big banks where they would talk about being customer-centric. They never really were, unless you had a ton of money. And then as credit unions, we are very member-centric. I feel in the DNA at Golden One. When I talk to others in the industry, I feel it as well. So I would say embrace that, and don't hesitate to figure out how we collaborate to actually meet member needs and advance the industry as a whole.
All right, thank you.
Great.
Well, now it's your turn. So if we want to, we've got about 8 minutes. Well, probably I would say 6 minutes, and we'll wrap up. But 6 minutes for questions. So what questions do you have? Oh, we got one right there. We'll get you a mic. Let's see if do we have a mic out there.
I think they have them set up.
Oh, you've got it.
Yeah, we can repeat the question.
So early in the presentation, you all talked about how to identify opportunities to extend innovative loans to your members. And part of what went through my mind is this is pretty innovative. Part of what went through my mind is if I were a member, I think that amount of analysis of my cash flows is a little bit tricky from a privacy perspective. So how do you handle that aspect of it? Because it requires a pretty granular examination of cash flows to derive this is what your smooth loan looks like, this is your financial health, that type of stuff.
Yeah. So the question is, how do you derive the level of, or how do you extract the level of detail you need from cash flows to do that type of financial modeling?
I would say, and the credit bureau.
And the credit bureau. Without potentially invading privacy. So certainly that detail is available both in the bureaus and especially in the transactional banking data. You can we do secondary classification of all sorts of transactions, and we put it in basically categories to try to figure out how what the distribution of spending is. If someone is giving you their banking data, whether it's through open banking data or allowing you to pull it from your core, then I don't know that it's disconcerting that you have that. You typically still, just like you do with credit factors, you represent it back as, perhaps a high utilization of discretionary, high percentage of discretionary spending, is done in categories that you consider risky. So you have to, your reason codes have to be a generalized, spending pattern type reason code.
The other thing I would add is I think two other factors. One is how you message to the member is critically important. So the interaction that you're having, the interaction can't be, hey, we looked at all your data and this is what we found. It's got to be, hey, you've been a member for 15 years. We love what you're doing with us. Here are some products that we can offer you. So I think that messaging aspect is critically important. And then the second piece is if you are pulling in alternative data, I think obviously you're gonna do it in a way that's regulatory compliant, and that'll be that should be evident to the member. A lot of them just click the box, but it should be evident and part of the process, and it should feel very natural that they're giving you consent. But that messaging piece is absolutely, I think that's the most critical part. It's how you position it with the member, so that it doesn't come across, to your point, as it's creeping, you know too much about my life.
Yeah, and we've seen more positive features being identified as a reason to approve than a reason to decline. So it might be, hey, based on our core model, we would not potentially give you credit, but you have regular experience paying your housing costs and your utility bills, and so that can be used as a positive factor that justifies maybe opening up your addressable member base rather than a derogatory, like you spend a lot of money on gaming. That's right.
Yeah.
I mean, you can see that,
That'd be
but
mine.
I haven't seen any lenders use that type of information to in a derogatory perspective.
Right, thank you. What other questions? Don't be shy now.
No. So we're available, so the Modelshop team is available at the booth. We can always answer questions offline after the session if you're interested.
Absolutely.
But
Yeah, well, thank you both, Chris and Tom, for today, letting me grill you a little bit with these questions. And we appreciate all of you for attending this session, and we hope you have a great rest of the conference.
Thank you, folks.
Thank you.
thank you.
Looking back, baby, we were clueless, but we fell so hard, like we knew what we were doing. And I remember the nights when we were young, dumb, and wild and free. When I closed my eyes, I could see you in my sweatshirt.